In this presentation, we're going to record transactions related to investment pool trust fund, recalling that there are three major categories of funds within governmental accounting, those being the governmental funds, the largest grouping of funds, the proprietary funds, those that act similar to a for-profit type of organizations, those that typically have something similar to customers within them, and then the fiduciary funds, the ones we're going to be working on here, those being ones where the fund is acting in essence like a fiduciary, like a holding account, managing or holding on to assets that are not related to the particular entity. So we're going to be dealing with an investment pool, trust fund, fiduciary type fund here. Scenario is going to be this: we're going to have an investment pool. So we're going to have investments, pool those investments together within the investment pool. The investments are going to be coming from the general fund. The general fund is going to be part of or related to the fiduciary fund. So the fiduciary fund is part of or being managed by the general fund here. And then outside funds are going to be the school district that's outside of the immediate governmental entities that are going to be pooling within this investment pool trust fund, the assets that they have, and a township pulling their money together. We're going to say that this is going to be the amount that was invested originally, the 900,000, the 4,220,000, the 4,090,000 by the general fund, schools, and township respectively. This is what they had in the investment in year one. Year two is going to be the year that we are in now. This is the year that we set up the investment pool trust fund. We're going to take these investments that had originally been put in at these amounts, now having changed due to the fair market value changing in year two, into this investment pool. So we're setting up this basically fiduciary type of fund, holding account, trust fund type of activity, pooling this together to have the service of pooling this money together, then taking that money, of course, and investing it. That's going to be the point of the pooling of this money together. So we're going to take this money, we're going to invest it then into U.S. Treasury notes and certificates of deposits. U.S. Treasury notes of 950,000, certificates of deposits 8,553,000. Transaction then looking like this: we're going to take this money in the investment pool trust fund, we're going to debit the amount into the asset account of U.S. Treasury notes, the 950,000, debiting the amount in the certificate of deposits 8,553,000, then crediting the due to the general fund. Note, this account is going to be basically a liability type of account, or similar to a liability, acting as a liability type of account, not going to be on the accounts similar to an income statement or temporary type of accounts, because the general fund here, these amounts related to the general fund are going to be related to the government that's going to be managing the investment pool trust fund, as opposed to the other two amounts, which are going to be for the schools and the townships, which are then going to the additions down here, which are going to be like the income statement type of accounts, increasing in a revenue type of fashion, looking at the activity type of fashion, because these two entities are going to be outside of the immediate government entity involved, and therefore we're going to record them down in a flow type of activity, investment or temporary account type. So if we record this out, then we're going to say that the increase in the treasury and the certificate of deposits, that's going to be the two asset type of accounts. Then we have the increase in the due to the general fund, increasing the general fund. And then we have the increase to these items down below for the schools and the township, down in more of the income statement type related activity down below the temporary type of accounts. Now we're going to jump from the investment pool. This is where we're pooling everything together, and think about, okay, what's going to happen in terms of some of these actual funds, the general fund, the school, and the township. What happens on their end, on their books? First, we'll take a look at the general fund. So within the general fund, we're going to say that there's an equity in the pooled investment. So we put in the 951 in the pooled investment. And if we think about the trial balance before that, we're going to say, hey, there was investments originally of the 900,000 in the general fund. That was in year one. That was last year before we put it into the pool. They had 900,000 on the books. Now we're taking that 900,000, which is now increased to 951 due to an increase in the fair market value of the investment, and we're putting that into the investment pool. So that means we're going to take this money out of the investment, put it into the investment pool. When we put it into the investment pool, it's increased in value to the 951. So we're going to debit 951 in the investment pool because that's what it's at the point of time that we put it into the investment pool. Then we're going to decrease the investments by the amount that's in there, the original amount that we put into the investment that we recorded it at, the 900,000. Difference between the two is, of course, revenue. So the 51,000 difference is the revenue that happened over that time period. So we're going to record the revenue change in the fair value as we put this money into the investment pool. Recording this out, then we are increasing the equity investment pool. That's what's going to be due to us from the investment pool. We are decreasing the original investment we had that was not recorded in the investment pool prior to this. And then we have the income of the increase in value. Let's jump over to the schools, same type of things, because the schools are participating in our pool as well. They are going to say that they're going to take the money out of the investments that they had, the $4,220,000, put it into the pool now. So we're going to be reducing this amount. It goes down to zero. We're going to put it into the pool at the current value. And then the difference between the current value and the investments is going to be the revenue that we record. Recording this again, we're going to say that the investment pool, the equity is going up, and we're decreasing the investments down to zero. And then we have the revenues down below for the difference, the increase in the value. How about the township? So now we have the township. Same type of activity, however, we have a loss down here, but similar type of activity. We're going to say, here's what they had at the original investment. This is what it was when they put it into the pooled investment. So here it is at the pooled investment. We decrease the original investment. They actually had a loss, which were recorded into the revenue here, but it's a loss because the investment went down in value, apparently. So we're going to say that we had the equity still due to them, and then the investment decreasing, and then we put it down here, and the change in the fair value is going to be an income statement account recording that change, in this case being a loss. Now we're going to go back to the investment pool. So now we're back into the pooled investment where these areas have pooled this information or this money together into the trust fund. And we're going to say now that the township wants to withdraw $3,112,000. So now it's in the pool. What happens if one of them wants their money back or wants some of the money, wants to take some of the money out? Well, okay, now we got to take some of the money out, township. All right. So we're going to give the money back to them. But before we do that, we got to record the fact that there could be an increase in the value of the investment. So we're going to say, all right, we're going to have to sell some of our U.S. Treasury bonds or certificates of deposits, and then we're going to have to pay that amount out. So in order to do that, then we're going to have to say, well, now it's increased in value at the point in time that we need to make this distribution, and therefore we're going to have to record this increase. Then we can go into basically how do we record the distribution. So to do that, we know that there's going to be an increase in the investment, but we're going to have to allocate that out to the individuals involved here as well, or the entities involved. So to do that, we'll have to work out a table. We're going to say within our table, we've got the schools, we've got the township, we've got the general fund. Here's the overall values, the 951, the 4,466,000, and the 4,086,000. If we think about the percentages then of the total, we're going to say, all right, here's the 951,000 divided by the total 9503000. That's going to give us our 10% about. And if we do that all the way down, we got the 4466000 divided by the 9503000. That gives us our 47% about, and so on and so forth, to give us the 100%. And then we're going to take our 41,000, that's the amount of the gain, multiply it times the 10, the 47, and the 43% about, rounded. That gives us our allocation of the 4,103, the 19,268, and the 17,629, or totaling up to the 41,000. And so that's going to give us our new total. So here's basically the breakout that we're going to be using then in order to make our allocation. So then if we make our allocation of this gain that happened, transaction is going to be increase in the U.S. Treasury notes. Then we're going to credit the due to the general fund for the 4103. And then the additions for the schools and the townships. So if we record that out, then we've got the U.S. Treasury notes increasing by the 41,000. Then the other side going to the due to the general fund here. And then we've got the schools and the township in basically the activity that's happening down below the temporary type of account. Next, we can then actually get the cash, of course. So now we want to convert to cash. So we're going to take this from the certificate of deposit. Notice we made the adjustment to the U.S. Treasury notes we're actually going to be taking it out of the certificate of deposit. So we're going to take it out of the certificate of the deposits. We're going to be increasing then the cash because we're going to sell the certificate of deposits. We're going to be increasing the cash. That transaction, increasing the cash, because we're going to need the cash now from the investments that we're now going to need to pay out to the township that wanted the money out of the pool. So we're going to have to increase the cash. We're going to take that out of the certificate of deposits. And then the next transaction will, of course, be us paying out that cash. So now we're going to pay out the cash. We're going to credit the cash to pay out the cash. We're going to debit the deductions, withdrawal from the pooled investments. So that transaction, then we have the cash. Cash is going down to zero. We're going to record this down below in basically an income statement or similar to an income statement temporary type of account. And that's going to increase from zero up by the $3,112,000. That's going to be for the deductions, withdrawal from pooled investment for the township. Next transaction. We're now going to record the interest on the treasury notes. So we're going to say that there's an interest and increase then of the $71,000. So we're going to have to record that increase. We're going to say that the cash is going up by the $71,000 and the undistributed earnings on the pooled investments. That's going to be the interest that was earned. So cash then increasing in the cash account, and the undistributed earnings, that's going to be similar to basically an income statement account that we're going to record down here, the $71,000. Now this is going to be a little bit odd of an income statement account. It looks like a revenue kind of account here, but it's actually going to be kind of a clearing account because it's going to increase. We got the undistributed earnings on the pooled investments, which we will then distribute. Once we do that, we will decrease this account here. Then we have the CD accrued interest of $49,000. So we have a debit to the accrued interest receivable because it's accrued. We haven't yet got the cash, but it's accrued. And then we have the undistributed earnings on pooled investments, once again being the credit. Recording that out, we have the accrued interest receivable increasing. The other side going to undistributed earnings on pooled investments, once again increasing. Now we have the 120 there. Now we got to take that and say, well, how are we going to basically allocate that out? How are we going to distribute that to the individuals involved, the school, the township, the general fund? You'll recall last time we had our breakout. This is our table. This is where we ended last time after allocating out the $41,000 gain. This is where we're going to start then and say that this is our balance that we ended off in last time. This is going to be our starting balance here. Then we say that there was a withdrawal from the township of the $3,112,000. The new value then is going to be these items pull over, of course, no change there. And then this one goes down to $991,629. Here then is our total. Now we need new percentages. So we're going to pick up new percentages by doing our percentage type thing, which is going to be like something like 955,106,103 divided by the 6432000. That gives us our 14 or 15% about. And if we did that all the way down, the 4485268 divided by the 6432000, that gives us our about 70%, and so on and so forth to give us to our 100%. Then if we take that and multiply times the gain of the 120, the 15%, 70%, and 15% times the 120 would give us the allocation of the 17,819, the 83,680, and the 18,501 for a total of the 120. That'll be our allocation. We could then record that transaction. So we're going to take it out then of the undistributed earnings on pooled investment. So now we're going to be decreasing this account. We're going to put it into the due to the general fund. That's the one that's acting like a liability account up top. And then we have the additions on the deposit in pooled investment for the schools and the township. So it's going to look like this when we record this out. So we took the actual basically interest revenue here, and we're going to remove it from where we put it in the holding account, taking this holding account back to zero. So it's no longer in the undistributed earnings because it's now been distributed. And that goes back down to zero. Where did we distribute it? Well, we put the 17,819 into the due to, kind of like a liability account, because that the general fund related to the government that's handling the investment pool. Therefore, it's going to be in this liability account that's going to go due to the other fund, the general fund. Then the other sides are going to go to the additions down below. So the additions for the school and the township, it's going to go down here. So we're increasing the amount to the schools and the township, which is similar to basically kind of like revenue accounts or temporary accounts down below. Okay, so now let's take a look going from the investment pool and go to the trust fund or the general fund. So now we're going to go over to the general fund. We're going to record the increase in value here. So we have the 17,819. We're going to say, okay, there's the equity in pooled investments is going to increase by that amount. That's going to be allocated out, and the other side going to then revenue for the investment earnings. So we're saying that the equity in the investment then increasing, the other side going into a revenue for the investment earnings. What about the schools? We're going to have a similar transaction, of course. Schools, we allocated this amount. We're going to have the equity in the pooled investments once again increasing, revenues increasing. So on this side, we're going to say, all right, now the pooled investments are increasing. So on our books on the schools related to the investment, their investment pool that's allocated to us has increased by this 83,680. And the other side is, of course, revenue, because that's the allocation of the revenue to the schools. What about the township? Same type of idea. We're going to say we have the equity in the pooled investments increasing for this amount, although note the township actually took this amount out as well, which we'll have to record. And then the other side is the revenue. So revenue went up. So this transaction, much the same. However, township also took out the 3 million. So now we're going to say the equity in the pooled investments goes down because they actually got the money of the 3,112,000. So recording that out, we're going to say, okay, the cash went up for the amount that they took back out of the pooled investment, and the amount in the pooled investment, of course, went down by the amount they took out.